Welcome to the Liquidity Event, a show about all things personal finance with a laser focus on taxes, financial independence, and equity compensation. Hosted by AJ and Shane of Brooklyn FI, each episode will focus on a personal finance topic, some driven by news headlines and sometimes driven by listener questions. And sometimes you'll just get two money nerds rambling about what they think is interesting. Just a quick note before we get started, this podcast is for informational purposes only and should not be considered tax or investment advice.
Hello, and welcome to the Liquidity Event. We're your hosts, Allie Jane Ayers.
And I'm Shane Paul Mason.
This is episode 145, being recorded on May 6th, 2025, airing May 9th. A quick reminder to your listeners, we will answer your questions on the pod if you leave us a message. You can disguise your voice and use a fake name if you're shy. That link is memo.fm/the liquidity event. How are you doing today, Shane?
I'm good. I'm great. I'm back from San Francisco. I was in San Francisco last week. We had a pod break last week, and now I'm back in Mexico packing up my house for renovations, which I forgot means you essentially move.
Yeah, you move.
You are moving, right. Yeah,
it's like
no
you
one
move,
prepared me for
but
this.
then it's like not guaranteed that you're moving back into a house because renovations historically take 30 to 50% longer than promised by your contractor, designer, what have you.
So why don't they do the math and just reverse engineer?
I know. And then surprise and delight, right? Just say, if they think they're going to finish it in March, just say June. And if it gets done in May, wow, here's a tip.
Yeah, I mean, I actually don't mind. I'm gonna be gone. I'm leaving for New York on Sunday, and then I'm essentially out of Mexico until October.
Wow.
So, and it's May 6th here, so I got like 5.5 months, which means they know I'm gonna be gone.
Yeah, so they'll start it on
5.5
September 15th.
So I'll get back to a floorless, wallless,
perfect. A shack, no windows. Well, I wish you the best with your renovation. Today on the pod, we've got some market updates. We had a recent kerfuffle in the market, see how investors reacted versus hedge funds. We're going to talk about tipping. I'm sick of it. How about you? Just kidding. I'm a great tipper, but not as good as I thought, which we'll learn about in a few, and why more CEOs are heading for the exit. And then we've got, of course, a listener question, which we will get to at the end. But let's jump into this article from the Wall Street Journal. The title is, what is the title here? As markets swooned, pros sold, and individuals pounced. I'm going to read the subtitle because it's important. Hedge funds have sold a net $1 trillion of shares this year, while 97% of Vanguard 401k investors avoided trading in early April. That shocked me. What did you think of that, this article and that subheading?
What part shocked you?
The fact that investors are finally listening. I literally just posted on LinkedIn the pod racing, like, it's working GIF, which is like, finally, it's working. No, you disagree? I
disagree. I think 97% of Americans have lost their password to their 401k login.
Which is great. That's the best financial advice I can give anyone is lose your password and don't log in. Or by the time you log in, you're like, oh God, I lost $200,000 in my 401k. I better go sell it. And then you like go in to log in and then you get scared. Or if it's Vanguard, you don't know where the goddamn button is.
Wait, what is that voice? Who are we? Is that the overactive trader voice?
Yeah,
overactive
or no, it's
voice?
someone who here's from his buddy that his
Good
portfolio
googly.
is down $200,000 and you gotta go sell. But it's like by the
Have you been?
by the time you actually go to sell, you're too chicken, or as Shane's theory, you've lost your password, or you're just like, I can't find this button, and what does this mean? How do I sell? How do I sell my portfolio? Like, anyone who uses Vanguard, the reason why Vanguard is a company that is owned by its shareholders, they don't do a ton of investing in their website. It's a very difficult website as a retail investor to buy and sell shares of your Vanguard IRA or your 401k. But I saw this as a win. I saw this as people have been listening. People have been, we've been through a big market dip recently, right? That was like March of 2020. So it's in recent enough memory. So folks have maybe graduated college, started jobs, or they're old and they've retired, what have you. And they're remembering that it dipped, but then it came back. So maybe they're like, I'm going to wait this one out.
Yeah, 100%. Yeah, I think there's a little bit more financial literacy, so to speak. But I also think that this tariff stuff, like the market didn't really have a lot of time to respond to it. And then they didn't believe in the tariffs. So I think the market was down 10% on the year for a very
Short.
thin slice of time. Yeah, it was just a little bit, maybe a week. So I don't think people really had time. Like we're busy, right? Like we're going to start responding over the weekend, start making some trades, et cetera. So yeah, I don't think America's just really had time to freak out. I mean, there's the people that don't love Trump's policies and they kind of use the impact on the stock market a little dramatically, I would say. I think there's a lot of people like, he wiped out trillions of dollars of value. Like, that's not how the stock market works.
Totally.
It's not like he took a flamethrower to a Tesla factory, right? Like, the means of production are there. The stock market is not the economy. So there is a little bit of overreacting from the political left and a lot of dunking going on. But, like, I get, like, the tariffs are a terrible idea. Tariffs are terrible. But it's not all it's cracked up to be. And the markets are back to where they were. So thank God there wasn't a lot of trading. And the funny thing about this article is that the retail investor, which has been historically known as dumb money for checks notes, buying and holding,
right?
is performed much better than the hedge fund. Hedge funds have performed in the past. And I this article to me, AJ, is a thing I really love to point out. I was in a group chat recently, and I think you'll really enjoy this. And they were like planning a party, and like some guy posted, we're talking about the tariffs for a second, a bunch of white guys in a group chat. And some guy posted a trading platform.
It's always a bunch of white guys in a group chat.
Yeah. And I was like, oh, XYZ, looks like you got a little trading platform there. Like, what you trading on? He was like, well, I do run a hedge fund. Yeah, so I do some day trading. And everybody else in the group chat was like, oh, dunked on Shane. Oh, he's got a hedge fund. And in my head, I'm like, dog, that's embarrassing. Like, I hate that.
Also, if you run a hedge fund, you shouldn't be trading out. You're probably restricted. But anyway, I'm not the SEC here.
Yeah.
So.
No, it was just a quote. It was just a quote, like on the peso to USD or something like that. There's like a bunch of Mexican or a bunch of white boys, a bunch of gringos. Anyway, in the spirit of this review of this article, I had to pull up the hedge fund performance, the composite index of the hedge funds. There's a composite of over 1,600 different hedge funds. I looked at the prior 10 years from 2015 to 2025. AJ, what do you think versus the S&P 500? How much better do you think the S&P 500? You already know, since I pulled this up and I'm actually talking about it, and the confirmation bias that I need to make my point has showed up here in the podcast. So how much better do you think it performed?
I mean, 2 times better? 10 times better?
Yes.
Yeah. 100%.
If you invested $10,000 in 2015, you now have $16K if you put it in a hedge fund. If you put it in the S&P 500, and by the way, this is before like all the fees and all that shit. So you would now, if you put it in the S&P 500 ETF, you would have $33,000. So you would have twice as much money. So cool. Yeah, dumb money, up 2x.
Stupid. You know, sometimes ignorance is bliss. That's my takeaway from this article. But it's an interesting part of investing, right? Is if you get too in the weeds, you can make yourself crazy. I mean, I think that's what's happened to a lot of, that's the Robin Hood effect, right? Is people getting addicted to what is effectively gambling. When you're day trading, you're trying to pick winners and you try to get out at the right moment when you're up and you're beating the house, and it's really hard to do that. So just kind of logging out, forgetting the password, especially in quote unquote times such as these, is maybe not such a dumb strategy after all. Anything else you want to say on this before we move on?
I have 4 more paragraphs on this.
Oh, please. Please share.
I was like, oh no, she's moving on.
Oh no, please.
No. Well, there was the famous study that was done by Fidelity. Don't worry about that.
If you're listening and not watching,
your background and Descript.
Somebody just walked by who I have never met before.
Hey, habla español. All right. All right. Everyone having a good time?
I miss you, bud. I can't wait to see you next week. We're gonna hang out IRL.
Miss you too. Yeah, it's gonna be good.
All right, tell me what else you got. There's
anyway. I got a couple more
things.
Tell
me.
I'll keep it punchy. I think, unfortunately, that our brains have not changed since tigers used to ruffle around in the high grass. So human beings have a predisposition towards action, right? We have an action bias because those of us that ran away from the wriggling in the bushes or the things in the trees, those are the ones that survived. We killed all the tigers. There's no more tigers to worry about. But when things happen, we get dopamine released when we do something about it. right? Like we all have this natural inclination, like, oh, well, there's something we need to do about this. There's very low acceptance of doing nothing, even when it is the right thing to do. So when the markets get roiled, your Goldman Sachs guy calls you up and he says, this is what we're going to do about it. And you agree with them, even though you probably, if you have enough money to work with Goldman Sachs, they're quoted in this article of having traded a ton during the market tumultuous markets of the tariffs. They did a lot of trading, which is
but it also
bad for your portfolio. And if you're smart enough to have money with Goldman, you probably know about this bias that you have, or doing something is oftentimes worse than doing nothing. So,
but also if you're charging your clients 2% of the total assets that you're managing and 20% of any profits, which is typically what hedge funds charge, like you have to take action. You can't just say, I'm putting it all in the market and letting it ride. That's you would lose all your customers. So you have to have this bias for action. Like you
got to justify your fees. Yeah, 100%. At least that 2%. The 20% is going to be harder to justify after all these losses. The last note I have on this is that I can't help but think about how in the 70s and the 80s, we shifted all of the responsibility of retirement savings out of pensions, which the companies were responsible for, defined benefit plans, and onto the individuals with the Internal Revenue Code, or with the code, 401, with the 401k, and how now all of the 90% of stocks are owned by 10% of the wealthiest Americans. And what do we have now? We have all of these 401ks buoying the equity values of all the richest Americans via this. We never sell, we just pump this in. You have to think that 50, 60 years ago, as billionaires were deciding the policy in the United States around retirement, they had to consider this as something that would help them out, right? So just something to think about.
Yeah, actually published a Substack post today called How to Be a Good Billionaire. Part 1, There Shouldn't Be Billionaires. It's kind of my first spicy post, if you will. I've been writing a lot about kind of like personal finance 101 stuff, and this is the first one where I was kind of like, I'm just gonna throw some opinions out here.
Can we go off topic for a bit and talk about that?
Sure.
Yeah, I mean, like income tax is 100% above $999 million type vibe.
Yeah, I'm
into that.
Not 100%. No, not 100%. I forget the things that I wrote this a while ago, but I was thinking a lot about like our clients, right? Our clients who will sometimes have these liquidity events where they will make $10 million in 1 year, or $1 million or $5 million. And they're getting taxed at, if they live in New York City, 56%. And I don't think that's fair because it's all income, right? Sure, maybe some of it's capital gains, but when you have that much in capital gains, you're basically pushing nearly 30%, right? It's something like, when we get there, it's going to be like 25-ish% with capital gains plus, net investment income, all that jazz. But like, could there be some kind of lifetime carve out for one-time liquidity events? So fine, capital gains tax, like let's keep the capital gains tax. I think it should go up after $100 million of capital gains recognized in 1 year. Personally, I think it should be 50%. That's one of my proposals. But could we have a $10 million lifetime carve out to pay a zero capital gains? And similarly for income, for these people who have these one-time, once in a lifetime experiences.
Okay. I was like, I know that you're a QSBS expert, so why is she discovering it live on the podcast?
Right. Well, exactly. Yes, exactly. QSBS is a great example of that, but there's so many hoops to jump through. This would be more for income. Yeah. It would be a $10 million. Hey, I had a great year. I'm paying tax. I haven't quite exactly thought it out, but just thinking about how the people that need to be taxed have too much money that they can't possibly spend in one lifetime. And every tax policy that we've seen that's quote unquote taxing the rich is actually hurting people who are making the transition from middle class to upper middle class. The people who are making between $500,000 and $10 million in 1 year. Let's just use those numbers.
Lawyers,
yeah, exactly. Like these are people who are working and contributing
executives
to companies, starting businesses, selling businesses. Like you have these, quote unquote Main Street mom and pop shops who are going to, maybe they'll be able to sell their building or sell their, business, their intellectual property for a couple $1 million. Like that should be their whole retirement, but they're getting hit with these big tax bills. So like, could we have a realistic lifetime carve out that's like, hey, you had your one shot, you did well, congratulations, you participated in the American economy, you get to keep a lot of that. Now, we got to put our heads together and figure out like what is quote unquote, what is too much money at a certain point. This idea of a wealth tax, I just don't think that's realistic. I don't think anyone's ever going to pass that. Any kind of flat tax just doesn't feel like it's ever going to happen. but could we get a little more creative with capital gains and income tax and giving people who are going to become that rich person, going to become that pillar in their community, could we give them more of a head start by having a less progressive tax code, if you will? Let's have a tax cut for the upper middle class, if you will.
Yeah. Okay. Word. I'm down with that.
Yeah.
Down with that. Is that what your article was about?
Like,
by the way,
is
this an opportunity for us to discuss the ends that the means, the ends and the means of the Substack?
Have you seen The Brutalist, by the way?
No.
Oh.
I'm bummed out about it. I'm sorry.
God, I just saw it on the airplane. Yeah. Holy shit, that's a good movie.
As God intended.
Yeah, exactly.
On a 7-inch screen.
I mean, it was a 10-hour flight, so that was kind of the only opportunity.
Yeah.
Anyway, there's this quote at the end, which I'm going to now botch completely, but it's basically
earmuffs.
Yeah, it's basically like the end is all that matters, not the journey. It's like the opposite of like the journey is the matter. It's like, no, it's like the end is what matters. Anyway, yes, the end, the reason for all this nonsense of the Substack is that I'm writing a book, which is super exciting.
The nonsense of the Substack.
I'm writing a book.
Which is like one of the fastest growing Substacks in America, according to
it's been
Substack.com.
Substack.com, yes. It's been exciting. Yeah, last Tuesday I got to make the news public. The book is called Creative Money, New Financial Rules for Artists, Innovators, and Misfits. It is coming out in November of 2026, being published by Penguin Random House, and I'm super stoked. And I just shared the proposal with you, Shane, which you are mentioned in 7 times, so I suggest you give it a read. Tell me what you think.
I controlled F for my name, read those sections, and moved on. Thank you. Hands
There was
clapped.
only one negative thing I said about you.
Have you? Oh, wow, naturally. That's a good. That's balanced though. That way people know it's not.
No, there's nothing negative about you.
Yeah. Ah, damn it. Rats. I was looking forward to holding a secret grudge. Have you seen BoJack Horseman?
Episode or 2. I know the characters, but no.
I feel like for an animated show, that one would resonate with you. Oh, it's fantastic. But, they use animals as stand-ins for... Well, who do you think the editor-in-chief of Penguin Random House is?
I forget. Yeah.
He's a penguin. Yeah. He's a penguin. He's great. He's one of the best. I think it's... who's the... God, I didn't remember his name. He's got that squealy... Well, anyway, moving on. Congratulations on your book deal. We're all excited. When can we expect it to... hit the shelves?
November of 2026. I got to write it first. I'm already behind.
NBD.
I have some ideas, though.
Right.
Anyway,
cool.
Yeah.
Okay, sorry. Back on track.
Host. I have a quick tip for you.
Okay.
Which is that I've got this article about tipping. It's a Wall Street Journal article called...
You know what I like to pay for when the service is great but the food is terrible?
Tips.
Just the tip. Anyway, moving on.
I'll give you that one. Tipping is everywhere, and customers are fed up. This is not New York Times. This is another Wall Street Journal article. It had this nifty little quiz that you could take at the top of the article to figure out how your tipping habits fall within the masses. And I took this quick little quiz. And I was disappointed. I think I'm a pretty good tipper, and I was disappointed to learn that I'm like a medium normal to good tipper. Like I was on the you're kind of in the middle of the road, but not the best.
Well, here's your chance to social virtue, which is a virtue signal, and the moral hazards surrounding tipping, which is. Let's now talk about it.
So what are your? I mean, look, I tip 20% in restaurants on the whole thing, no matter what. That's my vibe. I don't like pulling out service fees or pulling out alcohol. I don't believe in that. If I'm in a bar and I'm like paying cash for things, it's $1 a drink or 20% if I'm paying with a credit card. That's just mental math on my part. If it's the beginning of the night, I'm gonna be there for a while. Sometimes I'll be like, here's $5, keep them coming. What's up?
When does the dollar per beer? When does inflation impact that? Because it was $1 a beer when I was bartending in 2014.
Right. When beers were like
when do we go
$5?
to?
I don't know.
Yeah.
I mean, cash is interesting because I have noticed in the past 6 months I use cash so rarely now. It used to be, it's been dwindling, but now it's just like they don't want your like dirty beer soaked cash. They want the credit card. So that's I'm definitely tipping more because I'm tipping more than $1 a drink.
Wait, I don't get it because I'm looking at the results because the cool thing about this result or the survey is it shows you how you're compared to other people. There was a coffee. Are you tipping for coffee?
For coffee, I think I said 15%. If it's just, it was like if you're just getting a black coffee, or no, it was like a water. There was a water bottle at the airport, which was like, I'm not tipping. Fuck the airport. It's just a water bottle. I also got it myself and paid for it with the self-service kiosk and didn't interact with anyone. For coffee, it's like, here's just a black coffee. I'm not I'm a 15%. So maybe that's where I'm not in the top percentile. You're smashing 20 on that, or you're?
I love how you're. No, I'm not. If
Really?
I'm standing up, when the iPad gets switched around or what have you, there's a no tip happening.
Oh, I'm sorry.
I'm essentially working at your restaurant.
You ordered two. The question was, you ordered 2 cappuccinos and a muffin to go.
And a muffin.
Have you ever made it? Have you ever made a cappuccino with a fucking Italian espresso machine? It is a fucking pain in the ass.
Yes.
It is really hard to get that.
I used to do it all the time.
Yeah, and that's why I'm given the 15%. If it's just a black coffee, it's not happening.
Okay. All right. Well, I only get black coffee, so that's yeah.
Anyway, the gist of this article is that people are fed up with tipping. There's this quote here. Andy Rawlings regularly breaks out his phone at the end of a restaurant meal to do some math. Oh,
this was funny.
Looking forward to serving Andy Rawlings at the old Longhorn Steakhouse. Rawlings, a 54-year-old executive from Dallas, has found more restaurants adding credit card surcharges, cost of living fees, or other charges meant to support restaurant workers or in response to other costs, often 2 to 5% of the bill. Rawlings sees no need to tip on top of these. As he says, they shouldn't expose me to their business model's flaws. Thoughts?
Yeah, well, my favorite thing about reading all 3 of these articles this week are about the Wall Street Journal, which you forget how conservative and boomer the readers are until you go to the comments. And it's like, I'm sure Obama is blamed for tipping in the comments in this article. I didn't go into the comments, but it's either Biden or Obama is the reason that all this is happening. But yeah, it reminded me, he's a 64-year-old retired
54.
Energy executive. Oh, whatever it is. All right, it was
54.
But yeah, it was cracking me up.
Yeah.
My thoughts on breaking out the calculator. Yeah, his poor wife. She said it really bothers me. It's very awkward. But that's part of why tipping is out of control. Like, New York Times did a review or an analysis of why tipping is so out of control, and they came up with 3 reasons why. And I want to know if any of these resonate with you. One is that if one business does it, then others need to do it to keep talent. Because if this coffee shop over here pays $8 an hour or $15 an hour, and the other one pays the same, but they also accept tips, you're going to make more money at the other coffee shop. Before you know it, every coffee shop is requesting 15% tips on top of a black coffee where they just turn around and pour it in a cup and hand it to you, and then you walk away. The second thing is there's what this guy was talking about, which is the social pressure and the public viewing and the moral hazards surrounding if you do not tip, because you want to signal that you care about this type of thing and you're not stingy, and you know, restaurant workers only make $2 an hour, so you're paying their salary. So even though you're supposed to reward them for good or bad service, up and down, very few people do it because you look like a dickhead when you do that. When it comes to bad tipping, which I do maybe once or twice a year, I'll do. If it feels antagonistic, I will do a lower than 20%. And then the third thing is proliferation of credit cards, because you're constantly swiping. It's like no big deal to tap a little button. Whereas with cash, it feels like
your Apple Watch or your phone with Apple Pay. Yeah.
Yeah, so if you have cash, like, which nobody does, like you said earlier, it's just such a pain in the ass to get cash, and a lot of people, more and more businesses are even cashless now, which, by the way, that's probably a good thing for society and overall, because cash is mostly used for black market, for the black market
dark
transactions.
Market.
Yeah,
His
I
dark
forget
market.
those stats, but something like if we got rid of $100 bills, like drug trafficking would go down dramatically.
Yeah, we don't need to close the borders. We just need to go to $20 bills.
Right.
So it's interesting.
An all coin economy.
Yeah, exactly. As I was taking the survey, I was like, this is all about restaurants. Like, fine, whatever. I think where I tip the most is like services that I really don't want to do that I value. For example, like, I will go get my nails done, which is like, I used to like value as like a luxury. Now it's like a pain in the ass, but like I got to do it so my hands don't look gross, my feet don't look gross. And like, I will tip like 25 or 30% on like beauty services or like a haircut. So like, that's like an interesting part of the economy where it's not just like, okay, it's a coffee here, it's a restaurant. It's like, this person is actually doing something gross. They're like rubbing my feet. Like, I feel obligated to tip them more than for like work of making a cappuccino versus scrubbing the calluses off the soles of my feet. which I don't have that many. My feet are beautiful, by the way. You can check out my OnlyFans page.
I tuned out as soon as you started talking about your feet. So.
Cute toes 69.
For sure. You just wanted to slip that into the podcast, make sure that that's recorded. Make sure the AI knows that in case you ever ask it to write you a summary. By the way, she has cute feet. The last thing I want to say, the proliferation of credit card.
Exit.
Oh, end it. No, go for it. Wrap it up.
No. It was an inappropriate segue, so please continue.
All right.
What do you got?
Well, I was just so curious, like this credit card thing, like the excuse for using a markup, like, oh, it's a credit card markup. You and I experienced this. Like, we pay the credit card fees as a business, like a small business, and we can't negotiate with Visa, MasterCard, and American Express because we're not a very big business. Whereas, like Neiman Marcus, I'm sure can negotiate the credit card fees that they pay to Visa for accepting visas, right? So in the article, they talk about these credit card charges that are being forwarded on to the customer, kind of like tariffs are now in some snarky websites. So I was just so curious, like I'm sure our listeners are curious too, because they're generally financially minded. Visa, MasterCard, American Express, technically Visa, MasterCard are the two competitors. That's an oligopoly situation. What do you think? Why have the credit card charges not come down? AJ, I have to ask, what do you think the operating profit margin of Visa is?
Oh, it's funny. I literally just wrote about this. I don't know the operating profit margin, but I know that it was Chase, which has a very big stake in Visa or something, and their credit card division was up like 96% year over year or something like that. The credit card monopoly is an insane part of this economy that continuously gets ignored. Like this idea of like there's only 3 and we have to take credit cards because we will lose customers if you don't take credit. You will. I mean, I've literally been at dinners with people at a restaurant that doesn't take American Express, and people will literally not order more expensive bottles of wine because the Amex is their work card. And so they like will literally like spend less money at that business because the credit card's not accepted. So these businesses have to accept these credit cards. So like the market, you and I, people who love fucking credit card rewards, like we are forcing these businesses to take Amex because you and I are going to spend a lot of money because we need to as business owners. And so like they have to take our Amexes and they're going to eat the fees. It's a vicious cycle, Shane. I don't have the answer. There's must be an insane credit card lobby that is not attaching. All right. Shout out to Elizabeth Warren and Chuck Schumer, who it's been like 15 years at this point, but they in the 80s and early 90s were basically Schumer first and then Warren were advocating for transparency. And like it used to be that you would get a credit card and you literally wouldn't know what the APR was, what interest rate you were being charged, until Chuck Schumer was like, hey, this is totally unfair. You have to tell people what the interests are going to be charged. So that little box you get that we all throw away and don't read is called the Schumer box. So like that was one great step. And I think that was literally passed 30 years ago. And we haven't had any changes in how we deal with credit cards other than the fact that these fees to merchants have only gone up. I fucking hate this shit, Shane. I hate this so much.
Sorry, I was working up a joke on the
if your kids are listening.
What the Schumer box would be. That's enough about my ex-girlfriend. So anyway, the answer is 65% margins on $35 billion of revenue.
Yeah, it's a good business
and
to be in.
And you and I, you're trained in economics. If there's enough profit to be made, then other entrants will enter the market. We have 3. What's going on?
What is going on here? Yeah. I would love a ProPublica deep dive on this. I'm sure one exists. Speaking of deep dives, CEOs are deep diving off the employment ladder. Another Wall Street Journal article. Jesus Christ, don't we read anything else?
This is a coincidence that these made it to the top of the heap this week.
Why are more CEOs heading for the exit? Running a company isn't so fun in a volatile economy, and fewer managers want to take over. Tell me about this article, Shane. What are the key takeaways here?
Key takeaways are in 2024, 2,200 CEOs. There's that many of them? Jesus fucking Christ. Raised, tax the rich. They
right. Sorry, just want to shout out quit the median pay. Yeah, it's like don't feel too bad for them. The median pay for these CEOs who are exiting is $16 million. That's the median.
Right. Yeah. So it's the highest number of CEO turnovers since 2002. So outside of the normal, and the reason is apparently there's 3 things going on: artificial intelligence, they're not, the average age of a CEO is, I'm sure, not equipped to handle the artificial intelligence. I think it was the Information that called it peak ambiguity is where we're at now with artificial intelligence, which I really love. It's like, is it going to take all of our jobs? Are they running out of data? Are these agents actually going to become something in the physical world? Like, where are we at with it? So if you're, in your early 60s or you're towards the end of your career, like, why deal with it? Like, pass it on to the next guy that's 10 years younger, give him a shot. Dealing with DEI, the constant vacillation or oscillation back and forth, the constant vaccination, the constant, oh, by the way, I saw a Mexican dude yesterday that had a shirt on that he didn't know what the English said. It said, "I got snipped by Dr. Catherine." He had a vasectomy shirt on. The vasectomization of DEI. Oh, sorry, we're getting to the end of the podcast, so we're starting to burn out. The third thing is burnout is the new black.
Also, you owe me $5 because you didn't say the word. What was the metaphor you were supposed to say this podcast? You're all
these CEOs
and no
are all hat and no cattle. They don't really have what it takes. By the way, speaking of hats and cattle, AJ.
Yeah.
Wait. Oh no, you're frozen. We might be missing a part of the podcast. I think it hit right at 30 minutes here.
What happened? Go ahead. Sorry, you blacked out for.
Oh, it just froze at 30 minutes.
Yeah. It's all good. No big deal. You're gonna say.
We'll edit it back in.
By the way, AJ.
Burnout is the
hats and no cattle. What?
Yeah, these CEOs are all hat and no cattle. They all talk. They just can't handle running a real company, apparently. Unlike you and I, who are way ahead of AEDIA, whatever it's called. All right. And then, there's just a midlife corporate crisis. I think people are enjoying time with their families. Remote work made them realize how much they love spending time with their families, and it's just not worth it. And they're already rich, so fuck it.
Yeah, I mean, there was a good quote. I mean, the one good takeaway from this article is basically like, yeah, I have enough. Like, this is kind of what Brooklyn FI's ethos is. It's like, I have enough money. Like, I've made $16 million for 10 years. Like, I have a lot of money. I don't need any more.
Right.
Like, I am not eating, I'm not sleeping while running this company. And to your point, like, yeah, someone else needs to step into the role. Speaking of CEOs exiting, I mean, one of the most famous CEOs of all time, Warren Buffett, just announced that he is exiting by the end of this year, which is funny because in my billionaire post that I posted today, I was like kind of like roasting Warren Buffett a little bit. But like, obviously in his desire to exit, it's all like amazing outpouring of adulation. I roast him like jokingly, like just like the fact that he like lives in Omaha and like loves Coca-Cola and McDonald's. It was like a light jab, but it's just funny because if you Google Warren Buffett right now, it's just like these insane like long think pieces about his amazing career as the greatest investor of the 20th and 21st centuries, which he is. But it was just a funny, like, I was like, I'm not going to change this. It's fine. I'll leave it in. Anyway, I think that's
we don't mean to villainize wealth. We shouldn't villainize wealth in this country. It's when you're a dickhead about it and you don't contribute to society. Yeah.
It's just too much. Wealth is awesome and people work very hard and I am pro capitalism. I think capitalism is the only economic system that I've ever seen that works, but it's just there's too much in.
Don't use that on a dating app, by the way. You will get unmatched. I know from
that you like capitalism. That you're a capitalist.
Doesn't work.
Unless you put the word venture in front of it. Then...
Not at Burning Man. Or maybe it does at Burning Man. Shit, I got it backwards.
Yeah, you were trying to send me to Burning Man as a fantasy football punishment for next year.
Oh, yes.
No,
dear listeners, please write in.
I'm not doing this.
If fantasy football 2025
I'm not playing.
5, loser has to go to Burning Man. Put your notes in an email.
I'm not playing.
And send it in. Or if you have a better version of what one of us would have to do if we lose fantasy football,
I'm going to be a sore loser. I'm not playing next year. That's
John and I will play then.
Speaking of being sore losers, I'm going to wrap things up here and say thanks so much for listening. Email us your financial problems at liquidityevent@brooklynfi.com. Leave us a voicemail at memo.fm/liquidityevent. We will play it on the air. And finally, Stans can leave us a review if they want to be weird about it. See you next week, folks. Bye.